Good morning, everyone. Happy Monday. I hope you all had a great weekend. So Angela and I have been getting a lot of questions on the CARES Act, and we wanted to put something together that we thought might be helpful to our clients and our friends out there and answer some questions as best we can on what's going on with the CARES Act. It seems like things are changing every day in the employment area. And so Angela and I just want you all to know we are here for you to help answer any questions. Angela, do you want to say hello as well?
Good morning, everyone.
Okay. Oh, go ahead.
Oh, I just wanted to specify that the CARES Act is an 854-page bill. It is very dense. It does require, to a certain extent, some pretty extensive knowledge of the Internal Revenue Code. So this webinar is meant to be an overview of things that are portions of relief that are available to individual taxpayers and businesses under the CARES Act, but we highly encourage you to reach out to your CPA and your tax lawyer if you have one to help with any sort of application under the CARES Act. If you need a referral for a CPA or a tax lawyer, please let us know. We have a really great Rolodex of people that we work with, so we're happy to provide you with recommendations and referrals.
Exactly, yes. Okay, so to start off, how we always do, we want to start with a disclaimer since we are attorneys. Content on this webinar should not be considered legal advice and is for informational purposes only. Communications made through this webinar and or participating in this webinar do not create an attorney-client relationship. Hackler Flynn and Associates is not responsible for any content that you may access from third-party resources that may be accessed through or linked to this webinar. Some of the topics we wanted to cover today, as the coronavirus outbreak continues to impact markets and industries in the United States and around the world, businesses are now confronting significant and unique challenges. Successful navigation of these challenges will require thoughtful and comprehensive planning. The Coronavirus Aid, Relief, and Economic Security Act, known as the CARES Act, amends numerous provisions of federal tax law affecting both businesses and individuals. Many of the changes aim to help taxpayers conserve or generate cash, either prospectively or by amending prior year's tax returns. So these are some of the things we will discuss today. And mind you, this is our interpretation as best we can as non-tax attorneys. So bear with us as we cover this. So HR 748. So on March 25th, 2020, the Senate unanimously passed 96-0 the CARES Act, and this provides $2.2 trillion in stimulus to individuals, businesses, and hospitals in response to the economic distress caused by the coronavirus pandemic. On March 27th of this year, the House of Representatives passed the CARES Act by voice vote, and President Trump, of course, signed that bill into law the same day. So the stimulus provided in form of $349 billion loan program for small businesses, including 501c3s, nonprofits, and physician practices. These loans can be forgiven through a process that incentivizes companies to retain employees. $500 billion for assistance to businesses, states, and municipalities, with no more than $46 billion to support passenger air carriers, air cargo carriers, and businesses important to maintaining national security. The remaining $454 billion may be used to support lending to eligible businesses, states, and municipalities. Also, $130 billion in relief to medical and hospital industries, including for medical supplies and drug and device shortages. This also expands telehealth services, stimulus payments to individuals directly to Americans, It expands eligibility for unemployment insurance, which we'll go over, another $600 a week. And then it expands defense production. And I won't go into all the other things it's seeking to do. But so for the Paycheck Protection Loan Program, that's what we wanted to cover first and foremost. At a price tag of $349 billion, I know my slide says 350. It covers the period of February 15th, 2020 through June 30th, 2020, and greatly expands SBO eligibility. The loan program will allow businesses suffering due to the coronavirus outbreak to borrow money for a variety of qualified costs related to employee compensation and benefits, including payroll costs, and we'll go over each one of these because I know we're going to have questions. Yes, I'm happy to send anyone who emails me a copy of the slides. My email address is on the bottom, so that's no problem there. So payroll costs, continuation of healthcare benefits, employees compensation of those making less than 100,000, it caps out. So if someone, which we'll get into, mortgage interest obligations, rent, utilities, and interest on those debts incurred before the covered period. So payroll costs. Payroll costs are defined as wages, commissions, salary, or similar compensation to an employee, payment of a cash tip or equivalent, payment for vacation, parental, family, medical, or sick leave, allowance for dismissal or separation, payment for group health care benefits, including premiums, payment of any retirement benefits, and payment of state or local tax assessed on the compensation of employees. Now, this specifically excludes compensation for employees earning more than $100,000 a year annually. So for example, if you have an employee making $105,000 a year, you would be capped out at $100,000 per year, and you would disregard the $5,000 over the $100,000 annually. Federal taxes. There's been some talk on whether or not this is included. We'll be touching on that, but basically we really want you to check with your CPA and your payroll company. We've also been getting a lot of questions on how to handle employee commission. If you have employees who are on a commission-based pay, under the FLSA, to determine the rate of pay, you would take the wages plus commission divided by hours. And this is for employees who earn commission on top of a wage. So for eligibility, you are eligible for a loan if you are a small business that has less than 500 employees, or if your business is in an industry that has an employee-based size standard through SBA that is higher than 500 employees. We're not really going to touch on that since most of our clientele is under 500. The CARES Act does not describe when the number of employees should be identified for these purposes, but the SBA regulations look at the average number of employees in each pay period over the immediately preceding 12 months. There's been a lot of discussion on this too. When do you count your employee headcount? Is it as of today, or if you're basing your loan request amount based on 2019 payroll, is it based on that? We think that there will be additional guidance on how to calculate the number of employees. Typically, this is based on employee headcount by full-time equivalent, which means if you have 2 employees, both working 20 hours per week, that would equate to 1 full-time employee. There's a specific calculation on how to calculate full-time employee equivalents, and you take the number of part-time employees you have, multiplied by the average of total part-time numbers of hours worked in a week, and it's divided by 30. So an employee who's working 30 hours per week is considered full-time for these purposes. In addition, if you are a restaurant or hotel or a business that falls within the North American Industry Classification System Code 72, accommodation and food services, and each of your locations has 500 employees or fewer, you are eligible. There are also some specifics for tribal businesses, veteran organizations, nonprofits, including religious organizations who will be eligible for the program, but definitely check with your bankers. Nonprofit organizations are subject to SBA's affiliation standards. Independently owned franchises with under 500 employees who are approved by SBA are also eligible. I know we have some of those types of clients. Eligible franchises can be found through SBA's franchise directory.
And
yeah,
just to emphasize, one of the requirements is that the business needs to have been operational on February 15th, 2020, and had employees and payroll taxes or paid an independent contractor.
Yes, yes. Thank you, Angela. Okay, so the loan is limited to the lesser of A or B. And part A is the average monthly payroll costs times 2.5 plus any disaster loan taken out after January 31st of 2020 that has been refinanced into a Paycheck protection loan, or $10 million. Oh, sorry. The term payroll costs is defined within section 1102A2 to specifically not include compensation of individual employee in excess of an annual salary of $100,000 as prorated for the covered period. Taxes imposed or withheld, sick or family leave pay, or compensation for an employee whose principal place of residence is outside the United States. So this amount is intended to cover 8 weeks of payroll expenses and any additional amounts for making payments towards debt obligations. This 8-week period may be applied to any time frame between February 15th, 2020 and June 30th, 2020. If you have a seasonal business expenses will be measured using a 12-week period beginning on February 15th, 2019, or March 1st, 2019, whichever the seasonal employer chooses. These loans may be eligible for forgiveness on a tax-free basis. So if you haven't applied or been speaking to your banker, please do so immediately. An eligible borrower of a covered loan guaranteed under the SBA is eligible for forgiveness of the SBA loan in an amount equal to the following costs incurred and payments made during the covered period. This includes payroll costs, and this includes employee salaries up to an annual rate of $100,000, interest payments on covered mortgage payments, not principal payments, covered rent payments, and covered utility payments. The covered period means the 8-week period beginning on the SBA loan origination date. Taxpayers should note that the covered period, as currently stated, is for 8 weeks and not defined to match the loan term. If you would like to use the Paycheck Protection Program for other business-related expenses like inventory, you can, but that portion of the loan will not be forgiven. Unlike income from discharge of indebtedness, generally amounts that are forgiven are not included in the borrower's taxable income. I think we're getting a question here.
Yeah. The question is, we are an essential business manufacturing of government product. At the moment we are working, however, only on government products, not commercial. Are we able to apply for the loan? Our understanding is that yes, you would be, if you meet the other eligibility standards under the CARES Act for the Paycheck Protection Program, the Payroll Protection Program, then you would be eligible for this.
Yes. Okay. So the purpose of the Paycheck Protection Program is to help you retain your employees at their current base pay. If you keep all of your employees, the entirety of the loan will be forgiven. Remember, if you keep all of your employees, the entirety of the loan will be forgiven. If you still lay off employees, the forgiveness will be reduced by the percent decrease in the number of employees. If your total payroll expenses on workers making less than $100,000 annually decreases by more than 25%, loan forgiveness will be reduced by the same amount. If you have already laid off some of your employees, you can still be forgiven for the full amount of your payroll costs if you rehire them by June 30th, 2020. So you have a few more months to bring them back.
Rehire them and also raise your re-raise your salary reductions too.
Yes, yes. The purpose of this provision is to encourage employers to rehire any employees who have already been laid off due to COVID-19. Borrowers that rehire workers previously laid off will not be penalized for having a reduced payroll at the beginning of the period. There are other tax provisions that are included, and you should ask your CPA on how to take advantage of these provisions.
One thing that I do want to note is that if you have been on one of our previous webinars about the FFCRA and the tax credit, the payroll tax credit that's available under the FFCRA, this is meant, you just need to know that you will not get double credit for for this. The FFCRA tax credit is separate from the Paycheck Protection Program loan. But again, you'll need to work with your CPA to make sure that those two things are separate.
Right, right. And then somebody is asking us, can you have laid off people previously, or is it just during the 8-week period?
So what'll happen is that the when they're calculating out forgiveness, they'll compare the number of employees that you have now at the time of the period to the same period in 2019 and compare the two to see what the reduction is. And if you have less now than you did in 2019, then the forgiveness will be reduced by that amount.
Okay, so to encourage employers to rehire any employees who have already been laid off due to COVID-19, borrowers that rehire workers previously laid off will not be penalized for having a reduced payroll at the beginning of the period, right? So if you rehire your employees by June 30th of this year, you will not be penalized for the reduced payroll at the beginning of the 8-week period. So to seek forgiveness, a borrower must submit application with documentation verifying the number of employees and their pay rates, the canceled checks showing mortgage, rent, or utility payments, and then of course, if you rehire, you will not be penalized. Okay, so the SBA contains a provision which provides low interest loans to help businesses and homeowners during declared disasters in the form of emergency economic injury disaster loans. That is a mouthful. Typically, these loans cover physical damage to property and economic injury following a disaster. These loans are used if insurance and Federal Emergency Management Agency funds do not fully cover the disaster assistance needed. Okay. So for the emergency economic injury disaster loans, for the period between January 31st of this year and December 31st of this year, that is what's called the covered period. Eligibility is greatly expanded to cover the economic injury resulting from COVID-19. Now, eligible borrowers include most businesses with less than 500 employees operating under a sole proprietorship, independent contractor, and certain others, including most nonprofit entities. Furthermore, they may be approved solely on the basis of an applicant's credit score or by use of an alternative method to gauge the applicant's ability to repay. Additionally, applicants may request an advance of up to $10,000 within 3 days after the administrator receives the application, subject to verification that the entity is eligible under this program. The advance may be used for any allowable purpose under Section 7B2 of the SBA and is not subject to repayment even if the loan request is ultimately denied. So this is essentially allowing you to apply online. It's very simple. You go to just the SBA website, and you can literally have up to $10,000. You put in your bank account information, and assuming everything goes smoothly, you'll get a wire transfer of $10,000 directly into your account. I don't know how behind they are in processing these loans, but they're supposed to happen very, very quickly, and so that it will help cover payroll, things that it's eligible for. So importantly, the CARES Act waives, one, the requirement of personal guarantees for loans up to $200,000. It also waives the requirement that the applicant must be in business for a year, but you must have been in operation as of January 31st of this year in order to qualify. And then it waives the credit elsewhere test.
Meaning that you will not have to have looked for loans from other avenues. You normally with an SBA loan, you have to prove that you sought funds from other locations or other entities. This waives that test.
Right. Okay, and then to cover the individual stimulus payments, individuals that are compliant in filing their tax returns and are not claimed as dependent by another person will receive a rebate from the IRS. The amount of the rebate depends on the taxpayer's, 1, adjusted gross income, 2, what type of tax filer the taxpayer is, and 3, whether the taxpayer has children. Taxpayers making $75,000 or $150,000 if married filed jointly or less will receive the full amount of the rebate, which is $1,200 or $2,400 married filing jointly. Additionally, taxpayers will receive $500 per child claimable as a dependent. The rebate declines by $5 for each 100 of annual gross income exceeding $150,000 for joint returns, $112,500 for heads of households, and $75,000 for all other filers. To determine the amount of the rebate payable, the IRS will use a taxpayer's federal income tax return for 2019 if it's on file. If the taxpayer has not filed his or her 2019 return yet, the IRS will use the 2018 federal income tax return. If you haven't filed a return for either year, for example, you collected Social Security but did not have enough for taxable income to necessitate the filing of a return, the IRS will determine that you are eligible for a check based on your Form SSA-1099, the Social Security Benefit Statement. For federal tax purposes, the rebates will be characterized as a refundable credit against liability for federal income tax for this year, 2020. The rebates are payable only to eligible individuals and are not included in gross income.
Cindy, there is a question on the Q&A. Is the stimulus only for those people that are not working? It is not. It's available to all individual taxpayers. The only thing that will reduce your payments are if you make over the threshold that Cindy just went over. It's for any taxpayer. I will just note that even if somebody would not have normally filed taxes because they don't owe taxes because their income is minimal, you would need to file some sort of taxes in order to get the stimulus payment, because there has to be some sort of registration that you are a taxpayer. But it's for all individuals who all individuals will receive stimulus payments unless you make over the thresholds that are in front of you now on the slide.
Thank you. Okay, for purposes of this rebate, eligible individuals do not include non-resident alien individuals, any individual claimable as a dependent by someone else, and then trusts and estates. Importing existing rules on advanced refunding of tax credits, CARES basically treats these rebates as advances of tax credits allowed for tax year 2020. If the amount of the rebate is less than the credit allowable for 2020, then the taxpayer can claim the balance of the credit when filing the 2020 return. If the rebate ends up being greater than the credit allowable, then the taxpayer will not have to repay the excess because the credit for 2020 cannot be reduced below zero. Okay, ordinarily, if a beneficiary of a qualified retirement plan, we're changing gears here, such as a 401k or IRA, prematurely withdraws funds from the plan, the beneficiary is subject to both federal income tax and a 10% early withdrawal penalty for the year in which the funds are withdrawn. However, if the recipient has attained the age of 59.5 prior to the early withdrawal, the 10% penalty does not apply when the money is used for coronavirus-related distributions not exceeding $100,000, defined as distributions made to an individual in any of the three situations. One, that they were diagnosed with COVID-19 by a test approved by the Centers for Disease Control and Prevention, the CDC. Two, the spouse or dependent diagnosed with COVID-19 by such a test. Or three, experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, being unable to work due to lack of childcare because of COVID-19, closing or reducing hours of a business owned or operated by the individual due to COVID-19, or other factors as determined by the Treasury, presumably in guidance issued by the IRS. So CARES mitigates the tax consequences for up to $100,000 of coronavirus-related distributions that a qualified plan distributes during 2020. So there's no early withdrawal penalty. The recipient can pay income tax on the withdrawal ratably over 3 years, unless the recipient elects to pay all the income tax on the withdrawal in the year received. But why would you do that? Talk to your CPA. Within 3 years of having withdrawn them, the recipient can recontribute the withdrawal funds to an eligible retirement plan, not necessarily the same plan, without regard to that year's cap on contributions. The taxpayer may recontribute the distribution to another plan in one or more installments. For purposes of the rule, CARES basically treats the reinvestment as a rollover distribution and the trustee-to-trustee transfer within 60 days of the distribution. In general, rollover distributions reinvested in a trustee-to-trustee transfer within 60 days are not subject to income tax. Okay? All right. So the CARES Act temporarily waives the minimum distribution requirements for most defined contribution plans, AKA your 401k plan. Section 457B, deferred compensation plans that are maintained by an eligible employer, or 3 IRAs. This applies for all required minimum distributions that otherwise would have been required to be made in 2020. A plan will not fail to be treated as being operated in accordance with the terms of the plan during such period solely because the plan operates in accordance with the CARES Act, so long as the plan is retroactively amended to incorporate the new rules by the last day of the first plan year beginning on or after January 1st, 2022.
This is something that you should definitely be talking about with your plan administrator. If it seems as though you are not going to be able to make the minimum distribution requirements, definitely get in touch with your plan administrator and your CPA to walk them through what needs to be amended in order to take advantage of this temporary waiver.
Yes. So the CARES Act temporarily expands unemployment insurance for workers in various ways, including amounts available to workers through state-operated unemployment insurance programs. The law expands the scope of individuals who are eligible for unemployment benefits, including those who are furloughed or out of work as a direct result of COVID-19, self-employed or gig workers, and those who have exhausted existing state and federal unemployment benefit provisions. The only individuals expressly excluded from coverage are those who have the ability to telework or work remotely with pay, and those who are receiving paid sick leave or other paid benefits, even if they otherwise satisfy the criteria for unemployment under the new law.
One thing that I do just want to point out is that at least as of Thursday and Friday of last week, California's agency that distributes unemployment insurance, EDD, had not revised their application to sort of address the expansion of unemployment for self-employed or gig workers. So it's a little tricky right now. It does allow people to identify as self-employed. However, it has not been changed specifically. So it's just a little tricky. If you have independent contractors who are true independent contractors, make sure that they understand that they need to identify as self-employed. Otherwise, you could potentially be triggering an audit for EDD, and God knows that's the last thing that you want to have to be worrying about. So if you have if you have independent contractors who are true independent contractors who are planning to apply for unemployment, just make sure that you have a conversation with them so that they're clear that they need to identify as self-employed.
Yes, absolutely. We don't want to trigger any EDD audits. Okay, so increase in benefits, right? So qualifying recipients can receive, on top of amounts payable by the state's program, an additional $600 per week for up to 4 months, fully funded by the federal government. The extra funds may be paid as a separate check or together with the traditional unemployment check provided by the state. Additionally, recipients who were previously nearing the end of their unemployment can apply for an extension of 13 weeks with their state unemployment agency. However, the total benefit may not extend beyond the 39 weeks in California. So some tax benefits, the employee retention credit. New to the final version of the CARES Act is a 1-year only credit against the employer's share of Social Security payroll taxes for any business that is forced to suspend or close its operations due to COVID-19, but that continues to pay its employees during this shutdown. Eligible employers will receive a credit against applicable employment taxes for each calendar quarter in an amount equal to 50% of the qualified wages with respect to each employee. The amount of qualified wages taken into account for each eligible employee, however, will not exceed $10,000 per calendar quarter, and the credit will not exceed the applicable employment taxes owed for such calendar quarter. For each eligible quarter, credit against its 6.2% share of Social Security payroll taxes equal to 50% of the qualified wages paid to each employee for that quarter ending on December 31st, 2020, but will not exceed $10,000 per calendar quarter. That's a lot. Talk to your CPA about that. So for Angela?
No,
okay. So the tax benefits. Eligibility generally defined as any employer. One, which was carrying on a trade or business during the calendar year of 2020, and two, with respect to any calendar quarter for which any one of these were part of it. So A, the operation of their trade or business was fully or partially suspended due to governmental order as a result of COVID-19, or B, the calendar quarter is within the period beginning with the calendar quarter after December 31st, 2019, for which gross receipts for the calendar quarter are less than 50% of the gross receipts for the same calendar quarter of the prior year, ending with 2, the calendar quarter following the first calendar quarter beginning after the calendar quarter described in 1, for which gross receipts of the employer are greater than 80% gross receipts for the same calendar quarter in the prior year. So definitely, again, consult with your CPA to determine if you're eligible for this credit, but it is something you are going to want to bring to their attention to make sure that you can get it if you are qualified.
Again, just to reiterate for everybody, we're punching above our weight here. This is not, these are not topics that we generally delve into, but we want to be able to provide these things for you so that when you talk to your CPA, you can note, okay, am I eligible for this? Am I eligible for this? We want you to know what questions to ask your CPA when you talk to them about what potential options are available to you.
Absolutely. So the employee retention credit, any wages taken into account in determining the new payroll tax credit for family medical leave or sick leave as part of the Coronavirus Relief Act may not be taken into account in determining qualified wages for the employee retention credit. This credit is refundable if it exceeds the business's liability for payroll taxes. A likely outcome, given the 2 new payroll tax credits mentioned immediately above that were created as part of the Coronavirus Relief Act late last week. In addition, if an employer takes out a payroll protection loan, no employee retention credit will be available. If wages paid and payroll tax credit received EPSL or the extended FMLA leave are not qualified wages for the employee retention credit.
In other words, there's no double counting. You don't get credit for both FFCRA leave and this.
Right. And it's refundable if it exceeds the business's liability for payroll taxes. It's unavailable to employers who take out the payroll protection loan, which is exactly what Angela just said. You're not going to get double credit here. In addition to the various new payroll tax credits created by the Coronavirus Relief Act and the CARES Act, the CARES Act will allow for most employers to defer paying their share of applicable employment taxes from the time the CARES Act was signed into law, which was March 27th, 2020, through December 31st, 2020. Half of this deferment amount would be due on December 31st of 2021, and the other half is due by December 31st of 2022. Similarly, a self-employed taxpayer can defer paying 50% of his or her self-employment tax that would be due from the date of the enactment through the end of 2020 until the end of 2021, 25%, and 2022, another 25%. This means an employer that incurs its payroll taxes in 2020 may 1, defer payment of that tax until 2021 and 2020, but 2, receive an immediate credit against those yet to be paid payroll taxes via the sum of the emergency medical leave credit, sick leave credit, and new employee retention credit. This is great news for employers who find themselves without cash available. Consult your CPA again regarding the impact on income and payroll tax filings. As with other tax benefits, delayed payment is not available to businesses who take out a payroll protection loan. The Tax Cuts and Jobs Act of 2017 altered rules regarding net operating losses of a business or individual by disallowing all carrybacks related to post-2017 losses, providing for an indefinite carry-forward period and limiting the use of post-2017 losses when carried forward to 80% of taxable income. So the CARES Act temporarily reverses these changes. Losses from 2018, 2019, and 2020 will be permitted to be carried back for up to 5 years. As was previously the case, a taxpayer will be permitted to forego the carryback and instead carry the loss forward. Losses carried to 2019 and 2020 will be permitted to offset 100% of taxable income as opposed to the 80% under the Tax Cuts and Jobs Act. Again, consult with your CPA on these provisions. As part of the Tax Cuts and Jobs Act of 2017, Congress added a limitation on the individual's ability to use losses from a business. The CARES Act temporarily halts these provisions for 2020 and retroactive to 2018. As a result, a taxpayer who found a loss limited by the provision in 2018 or 2019 can file an amended return to claim a refund. Again, talk with your CPA. As part of the Tax Cuts and Jobs Act of 2017, a business's ability to deduct its interest expenses was limited to 30% of its adjusted taxable income, with an excess carried forward. The CARES Act temporarily increases this limit to 50% of adjusted taxable income for 2019 and 2020. In addition, if a business does not have a taxable income in 2020, the business can elect to use its 2019 adjusted taxable income in computing its 2020 limitation. So generally, we're going into student loan debt now. Generally, if someone pays a debt on your behalf, it's a taxable income. As part of the CARES Act, an employer can pay up to $5,250 in 2020 of an employee's student loan obligation on a tax-free basis. Note, however, this provision modifies an existing rule which permits an employer to pay up to $5,250 of an employee's qualified educational expenses. For example, obtaining an advanced degree, with the payment being tax-free to the employee. This is now a combined limit. So an employer could pay $4,000 towards an employee's advanced degree and another $4,000 of that same employee's student loan payment in 2020. But the maximum allowed that will be tax-free to the employee is $5,250. In addition, the employee cannot deduct the interest on the student loan. And again, talk to your CPA about this. So some charitable contributions. 2017 nearly doubled the standard deduction, while at the same time limited or eliminated many itemized deductions, including charitable contributions, right? So the CARES Act allows an individual to make a cash contribution of up to $300 made to certain qualifying charities and deducts the contribution above the line in computing adjusted gross income. As a result, the taxpayer receives the deduction in addition to the standard deduction. The above the line deduction is here for 2020 and beyond, but is available only to a taxpayer who does not itemize their deductions. Again, consult your CPA. For taxpayers who do itemize, the CARES Act allows such contributions to be deducted up to 100% of the adjusted gross income for 2020, with any excess contributions available to be carried over to the next 5 years. For corporate donors, the limit would increase 10% of the adjusted taxable income to 25%. Again, consult your CPA. All right, so I know this was kind of a brief update on, the CARES Act. Angela and I just wanted to equip our clients and our friends, with anything that might help them with regard to talking to your CPA or your tax attorney. And, we just wanted to remind you that we are employment lawyers, just trying to help out everyone. And make sure, you're talking to your employment lawyer regularly and your CPA regularly, frankly. Make sure they have an experienced team of attorneys or CPAs behind them. And something we always like to do for our clients is a liability assessment early on. We do have an employment compliance checklist. If you haven't gotten it, please email me. I'd be happy to send it to you. It just is a rundown of all the things you want to do to ensure compliance in the employment law arena. And then you can always text us to get up-to-date news information. We are pumping out a lot of information. The Department of Labor is coming out with things, what seems like daily, Angela, right?
Yeah.
And we are doing everything we can to get that information over to our clients.
And one thing I just want to point out is there are, we've gone over all of these provisions that will maybe allow you guys to stay operational for some time. Just realize that none of the rest of the California wage and hour laws still apply. Minimum wage still applies. Overtime still applies. Meal and rest breaks still apply. None of those things have been suspended in operation because of COVID-19. So you want to make sure that you're still keeping track of all of those things, and we can absolutely help you on that front.
Absolutely, absolutely. And here's our contact information in case you don't have it. And, you know, you can always email us if we know the answer to anything. We're happy to do that, to answer. And yeah, we wish you guys the best of luck with interpreting the CARES Act and with, you know, with your employees. So we're here for you if you need anything.
All right, thanks everyone.
Thanks.